Okay, so we are starting the next chapter, which is chapter number 12, and this chapter name is payables, provisions, and contingent liabilities. So there are three very short mini things that we'll discuss in this chapter. This is not a long one. So first thing is payables. Payables, we've already discussed it. I'll just give it a recap. You know, the credit purchase and all that we have seen before as well. After that, we'll discuss the provisions. This is a new thing, and the contingent liabilities as well. So these three things we'll be seeing in this chapter. Okay, so first of all, let's see. As you know, these liabilities I also discussed in the first day as well, that liabilities are basically known as whenever anything on credit happens, especially a credit purchase, or sometimes we take a loan as well. So liabilities is known as that. They are classified into two types, as you know, non-current liabilities and the current ones. So current ones are basically which are lasting less than 12 months, and non-current are which are more than 12 months. For example, like a bank loan or anything. And current liabilities include mainly these things which are written over here in the examples: payables, bank overdraft, loan, any kind of short-term loan that we have. It is classified under current liabilities. Okay. Now, this is the official definition for the liabilities that we also looked at it again on the first demo as well. So liability is defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in outflow from the entity of resources embodying economic benefits. So this is a very difficult one to learn. The easier one to understand and learn is the one that I explained you in the day one lecture, and the
Yeah.
slides you already have for them. So in simple words, you can understand it like this: a present obligation arising from a past event which will result in economic benefits to be outflowed. So this is the easier one, but whatever you like, you can remember that. And more emphasis will be towards understanding it, not learning it. Okay. So the obligation must be capable of being reliably measured. So there is a main word in this definition, which is called obligation. So the main purpose of this chapter is also to discuss the difference between a liability and a contingent liability. So normal liability, we know what that is. So what happens is, I'll explain you what the difference is when we go to the contingent one. So in the main liability, we know two things for sure beforehand. One is the timing. We know what is the timing, and secondly, we know what is the amount. Like for example, if we have to pay a bank loan, we have to repay it back to the bank. So we know at what time we are, for example, paying the interest payment, or at what time we are paying back the principal amount, right? So exact time we know, and also we know what is the exact amount that is to be paid in installments or anything like that. So
Yeah.
both things are beforehand known in the liabilities, but there is something different and a very much twisting story in the contingent liabilities, but that we'll discuss when we'll move on to that topic in just a while. So obligation may be a legal obligation or a constructive one. So these two we'll also be discussing in just a while. So this accounting standard is basically known as IS 37. This is basically the provisions and the contingent liabilities. So according to IS 37, a constructive obligation may be established by a company having established or published policies. So detail again we'll be discussing. We don't want to read it from here. There is a detail in just after 2 pages. So we'll read it from there. Okay, so this was just the basic introduction of liabilities. We have already seen it in much detail in the earlier days as well. This is some detail about the credit purchase and the cash purchase. So as you know, what happens is that both sales and purchases, essentially all the transactions, they happen either on cash, either on credit basis. So cash one is very simple to understand. We pay cash there and then. So the double entry for this is, as you can see over here, debit purchase and credit cash. So simply it's that we increase the purchase or the expense, and we decrease the cash because we're paying it there and then. But the other thing is credit purchase. So what happens is that we'll discuss this accrual concept as well. This has a separate chapter, as I told you before as well. So what happens in credit purchase is that we create a liability for just the time being that we are paying the supplier. So just for the time being that we have taken the credit period. So what we do is, first of all, debit purchase. We don't do credit cash as yet because cash has not gone out. So credit we do only payable over here. And when actually the time for payment has come, then we minus the payables, we take them out, we finish them by debiting the payables. That means by decreasing the liability, And secondly, we actually decrease the cash at this point because now we have paid it. Before we did not pay, we just took the delivery of the goods. Okay, so this is the normal credit purchase treatment that again we have seen a lot of times in previous classes as well. Now the main topic for today is this one, which is called provisions, and this is going to be very interesting, and again it's a very easy to understand topic. Okay, so let's start it. First of all, let's discuss the definition of provisions according to the official definition of IAS 37. Okay, so a provision is defined as a liability of uncertain timing or amount. So let me give you small practical examples as well. Um, in fact, the example is written over here. Let's read it from here. So again, simple thing to understand over here is that yes, provision is a liability. The definition meets with the liability exactly, but only two things which are not present in provision is timing and amount. We don't know when to pay the liability, and we don't know what is the amount of that liability. So let's see an example. For example, a company may face legal action for breach of health and safety law. The likely repercussion is that it may be fined if the court judgment is made against them. The timing and severity of the fine will be decided by the court at some future date. Yes, it actually happens in real life as well. That yes, all the things that happened, the claimant has, successfully filed a case against the person, and maybe a restaurant has given him bad food, food poisoning has happened, anything has happened. So what happens is that court does not decide as yet. It does not decide the very next minute that what will be the amount and the timing, right? So obviously it is a very uncertain thing, which is in short known as provision, and court will decide these two things at any future date. So the key question over here is, should the company reflect this information in its financial statements or not? So all about this we are going to study regarding the provisions, the accounting, the treatment, everything. Okay. Now, if we assume that potential fine could be significant, um, it could even lead to closure of business. Should the potential consequences be disclosed to the shareholder in some way? So all these kind of questions are there. Let's move to the actual answer of them, like what actually we have to do. So provision again, if you remember the last topic, in the last class we discussed the receivables topic, right? And in receivables, you remember I taught you the receivables allowance as well towards the end. So you can remember it as allowance because it is the exact same thing. It's exact copy paste of the allowance, because in allowance I also told you that that's a market based figure. It involves very much uncertainty, right? Although provision is not market based, but the uncertainty figure in both things, in allowance for receivables as well and in provision as well, it's very common in both things. Okay, so both figures are very uncertain, but provision relates to liability and allowance relates to the receivables, which was the asset. Now let's see what is the accounting for provision. Okay, so let me also give you a more simple example. There was only one example over here. This also might be very difficult to understand. Let me give you a simple example. Okay, for example, I've started a business today and I've started manufacturing mobile phones. Let's say I've started manufacturing mobile phones. I have machines all over that are working on making mobile phones. So what happens is, obviously it's a very risky product. Anything, as you know, which is electronic product, it's a very risky product because there is a high risk that customers may bring the product back to my factory and claim the warranty for it. Right now, the thing over here is the word that I used is warranty. So in real life, what businesses do is that yes, they are providing warranty 1 year, 2 years, any period of time. What's happening at the back end, what's happening at the accounts department of the company, the finance department, they're providing this facility to the customers of warranty. But in the accounts department, as soon as they sell a product, they also have a provision and an obligation to satisfy. So what they do is that when they give the warranty with the product, they have to create a provision with it. And it is a perfect example. You can see by the warranty, if I'm the company, I'm selling the mobile phones. Okay. You can also think yourself, if you're selling mobile phones, you don't know two things, right? And what are those two things? Timing and amount, right? So if there is any liability in which we don't know the timing and amount, obviously it is a provision. We just read the definition right now, right? So what's happening is that we don't know the timing when the customer will come in the 1 or 2 years. He might come at the 24th month, he might be there at 18th month, he might be there at the second month, he might be there after 2 hours, right? So we don't know the timing, and we don't know the amount as well. We don't know how much damage to his phone has happened, whether we have to change many components, the expensive components, or whether we just have to, reinstall the software. Is it a hardware problem? It is a software problem. So these things we don't know as yet. So this is the perfect example for provision. And this is a more practical one as well. Okay. Now let's
So
see
you
what
have
will.
to create a provision because, I mean, there is a warranty for
Yes.
the mobile phone, and you don't know what's going to happen, if it's going to break or what, and then you have to basically repair it and
Yes.
reflect it in the account.
Exactly. So that's why we're all doing this provision system. Now remember, this is not for the customer. This is for the seller. Okay. For the company who is selling the product. Okay.
Mm-hmm.
Now, whenever we are recording a provision, it's very simple to record it. The double entry for this is we debit the expense, because what we're doing is it's kind of like we are recording an expense on a credit basis, right? Now, I am the company who is selling the mobile phone. Let's imagine I'm not paying any cash, right? Because maybe my own people are working. I have employed the technicians and the people who will repair the mobile phones if they come in as a bad product, right? So what I'm doing is debit expense, credit provision. Why credit provision? Because it's a liability. I'm not paying any kind of physical cash or notes or coins as yet, right? So what's happening is, yes, I am recording the expense. We'll study accounting concept as well in further classes. So this will be more clear to you at that stage also. So debit expense and credit provision, we're not recording a liability, we're recording a provision. So only difference between liability and provision is the timing and amount. These two things are not known in the provision. That's why it becomes a perfect fit for such kind of situations, like a warranty claim, any kind of court case that is pending. Okay. So this is whenever we are recording a provision, whenever a new provision has arise over here. Now, criteria, this is also very important. Criteria for recognizing a provision. Just give me a second, 1 second. Okay. So let's read it from here. So given the uncertainty relating to provisions, there is a significant scope for accounting error. Yes, obviously, because there is very much uncertainty over here, or even deliberate manipulation of provisions to alter profits. So as you know, provisions entry that we studied just now, that provision basically increases the expense, right? If we are making a provision, we are automatically also making an expense. So what some companies did was, before the application of this IS 37s, in the old medieval times in the 1980s, 1970s, companies started to misuse this provision, because there was no regulatory body that was assigning the accounting standards, because these all accounting standards are modern ones. Mostly they came after the year 2000, 2001, right? So what happens is that they were just creating provisions in a fake manner and manipulating their profits in a very uneven way. They were basically misusing it. Then IS 37 came with strict rules, right? And these rules are written over here. You might have seen these rules apply to all the IS standards. Like we also studied in IS 2, it should be lower of two things. Then in IS 16 as well. Then in intangible assets as well, there is a criteria to follow, right? So even in this, there is a criteria that a provision should only be recognized when these three things happen. So first thing is, entity has present obligation as a result of past event. So this is exactly the first line of liability definition. There is no issue in this, right? Liability definition, as you remember, it is a present obligation arising due to a past event. Now, second thing, it is probable that outflow of resources from economic benefits will be required to settle the obligation. Again, this is a liability concept principle. And the last thing is, a reliable estimate can be made of the amount of the obligation. So again, we don't need to know the exact amount, because obviously there is uncertainty, and only two things over here are uncertain: the timing and the amount, right? So it's not important that we know the exact amount. If we know the estimate or a reliable estimate, that works over here too, because most of the companies follow a reliable estimate. Obviously it's a provision, we cannot ascertain a real amount to this. So these three things need to be there. First of all, there should be a present obligation. We might have a responsibility as yet right now due to a past event. Secondly, there should be an economic benefit, sorry, there should be a obligation to settle it, right? We should have a promise that we have to fulfill. And thirdly, we will have to estimate a reliable estimate for the amount that is to be made for the provision. So these three things are very similar to the liability, but only the third point is a little bit different.
Yeah, that's true.
Okay, right? All right. So let's also see this illustration so that we get more clear. So the criteria referred to above mean that provision can only be recorded in accounting period if recognition of a liability has been triggered at the year end. For example, Smith Limited's year end is 31st December 17. In November 2017, they dismiss an employee. In February 18, a customer slips whilst on their premises and breaks their arm. In March 18, both the employee and the injured customer sue Smith Limited, the former for unfair dismissal and the latter for compensation of injuries. So what's happening is that they both have sued the company in the customer he fell, and the unfair dismissal that happened over here. So what's happening is the solution. Let's see this. There is a potential obligation at the year end for employee claiming unfair dismissal. This is because the triggering event happened in November 17, which is before the year end. So these are just normal concepts that we should, just understand. There is nothing to learn over here. There is a table, a big table over here that we have to
Sorry,
remember.
so even if they don't know that these two will or the other one will sue them in the future, they
Yeah, yeah.
still recognize the obligation.
Exactly. So that's what I'm talking about, that they will have to recognize a provision over here.
Yeah, even if they don't know that she's going to sue them.
Exactly, because obviously they have got a bad sign, right? A bad sign has happened that a customer has fell or an employee, they know that they have done wrong. So obviously they will have to create a provision. So you can also take it as a second example. I gave you the first example of warranty. So second example can be this as well. Okay, but the detail for this we are going to study. It's at the 4th page of this chapter, and that is basically a table that will help you in the exam questions as well. So this is just a very simple, basic example. There is nothing much to see over here. Now we are moving towards the obligations. This is another subtopic in this. So obligations, as I just discussed above, they are of two kinds. One is constructive, one is legal. So basically, what is the obligation? You can just remember it as a simple word, a simple English word is promise. Any promise that is to be fulfilled. So first, let's discuss the legal provision, and then we'll discuss the constructive one. So a legal obligation is an obligation that derives from terms of the contract, legislation, or other operation of law. So there is an exam in I'm saying ACCA, which is F4, and it is known as law, the exam for corporate law. So you'll study that as well, and that has even more details about all the laws, especially the UK laws. So the detail for this, all the things, what happens, what not happens, will be covered in F4 exam. Okay, so terms of contract can be anything that what has agreed beforehand before starting the contract. Then legislation, what are the laws and regulation of that very country in that the thing has happened, and other operation of law. So this is a legal obligation. So in easier terms, you can remember it as the obligation that you have to fulfill as being a part of a citizen of that country, right? So if there is any person that is a citizen of, for example, let's say England, UK, so he has to fulfill the obligations in that country. Any other country may have different kinds of obligations, right? So this is legal obligation. This comes at first priority, right? Firstly, we have to see the legal obligation, and then secondly, a subjective matter is this constructive one. This is a very subjective thing. This does not involve any legal thing. This is a very subjective one. Let's see what actually this is. So a constructive obligation is an obligation that derives from entities exchange where, so two examples are written over here, by established pattern of past practice. So these words are very important. Past practice, published policies, or sufficiently specific current statement. The entity has indicated to other parties that it will accept certain responsibilities. Only keyword over here is past practice. Let's take an example. Let's say there is a supermarket which is close to my house, and that person knows my family and me as well for many years, and he has very good, the owner is basically sitting over there at the main seat, and he has, with other relatives as well, other neighbors as well, he has very good relations with them. So constructive obligation, let's first discuss a legal obligation. So there might be a board, the government officials might have come one day, and they might have a board over there that it clearly says no refund, no exchange, no refund, basically. No exchange, no refund can be possible over here. This is a legal obligation. But let's say a constructive obligation, this will be that he might have good relations with the customers, because that's actually what business is, right? So what happens is that even legally he is not obliged to accept the returns or give the refund, even if the product is wrong, right? But let's say, due to good gesture, as a good gesture for maintaining the relationships, he it is a past practice of him to give everyone the refund if any product is damaged, or wrong size has came or anything wrong. So this is a perfect example of constructive obligation. Legally he is not obliged to do it, but constructively, yes, because of past practice, because of customers mindset, he has basically influenced them, right? And the second thing is, as a result, the entity has created a valid expectation on part of those other parties. So the word over here is valid expectation. So the customers who will go to them, they will think in their mind, as there's a word brand image, right? So whenever a person is walking into a brand, a shop, he has a brand image, like what does this brand offer, like do customers actually buy it? Everyone has a different perception. So same thing is happening over here. A valid expectation is created in everyone's mind, that the people might see him as a very humble person, as a very polite person. So they may ask him humbly to accept the return or give them the refund if the product is wrong, even though he's not legally obliged to do that. Okay, so this is the perfect example that you can learn for this constructive obligation. Again, there is no need to learn these definitions. You just have to understand them, what they actually mean over here. Okay,
Mm-hmm.
right. All right. So now let's take a short break, just let's say a 3-4 minute break, right? And after that, we'll start the main thing over here, which is contingent liabilities and contingent asset. So this will be the last thing, and after that, we'll move towards the question. So just a 3-4 minute break. Okay.
Okay, thank you.
All right, let's continue. Let's start this next one, which is the contingent. So this is a new thing. So basically, what happens is that contingent and the normal words. Let me explain you the difference, that what happens in between them. So contingent is a new word that we have never studied before, and this is just coming for the first time. So let's first understand contingent in easier words, in easier formats. Okay. So the only difference between the normal liabilities and the contingent one is that basically contingent means that anything dependent upon a condition. Let me write over here. Anything dependent upon a condition. So anything which has a condition attached with it, right? This means basically contingent liabilities. Like let's say, mostly ACCA exams, this is a basic thing that if you don't have preparation, you don't have to give the exam, right? Because it doesn't make sense. If you have the preparation, then yes, you should give the exam because you have to move forward in the exams, right? So this is a contingent thing. It is dependent upon a condition. So same thing is happening over here. One is the normal liabilities and the normal assets, the normal definitions that we studied at the day one in the demo. And second thing is contingent liabilities and contingent assets. So contingent liabilities and assets are any liabilities and assets which have conditions attached to it. Now there is a slight difference in the definition. Let's see what that is. So first let's discuss about contingent liability. Okay. Now you remember the normal definition. The definition was a present obligation that arises from past events, right? So the only difference you can see over here, a possible obligation. So the word over here is possible. So you see that this is attached with a condition over here. It is possible. It might arise, it might not arise, right? So a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. So again, the thing is that it is dependent upon a condition. This is a more formal definition, but the only thing that we need to remember and understand over here is that this contingent liability is dependent upon a condition. We'll see example of this as well in just a while. So secondly, what's written over here is a present obligation that arises from past events but is not recognized because it is not probable that outflow of economic benefits will happen and the amount of obligation cannot be measured. So I think this is the more suitable one. You can either understand this one or memorizing can also help. But the thing is that
Yeah,
we just
but
understand.
yeah, sorry. It's just I don't understand the difference between, the provision and contingent liabilities then. I mean, it's
Yes,
not the same thing.
exactly. It's not the same. So what happens is that, look, there are three things. Let me explain over here. One is liabilities,
Yeah.
the simple liability. Then second
Yeah.
thing is provision.
Yeah.
And third thing is contingent liability.
Yeah.
Okay, so liability was the same thing that we discussed on day one, a present
Yeah, that's
obligation
fine.
arising from the past event. Now,
Yeah.
provision is also a liability, but the only two things are not present over here, the timing and the amount. We don't know that,
Okay.
right? Now, contingent liability, it is same as a normal liability. The only thing here is that this will depend on some conditions. This is a contingent one. This will depend on future conditions. This will depend on future events. So there is nothing such as that we don't know the amount or the timing. There is nothing such as this in this one. We know all the things, but it will just depend on future conditions. Like if this will happen, then this liability will be correct, right? We'll see the example so you'll be more clear on this. So when provision is not recognized in financial statements because it does not meet criteria, it may still need to be disclosed as a contingent liability in financial statements. So now we are going to see in just a short while that table that I was talking about, that we will see, and this will further make it clear about contingent liability and contingent asset. Now examples for this you can see over here. Outstanding litigation where potential cost cannot be estimated without any degree of reliability, or when the likelihood of losing the litigation is only deemed possible. Now, one thing over here we can say that provision and contingent liability both are very similar. They're not the same,
Yeah,
but
this
both
is
are
the thing. Yeah.
exactly. They're both very similar, but they're not the same. They don't have the same definition. So the only thing what you can do is that just differentiate them from their definitions. If you know all the three definitions, all the liability one, the provision, and the contingent liability, you'll be more clear about this. This is the only condition over here. Okay, so any kind of litigation or a court case that is pending, right, we may know the reliable estimate of it, we may know the amount, we also may know what is the timing of that, what will be the actual court decision, when, at what date will it be, but we might not know what will happen actually. So this can be called a contingent liability. So again, the thing over here is future events. It might depend on events. There is no word over here such as we don't know the timing or amount. That was actually provision. But contingent means that it will depend on certain future events. Okay, so this was contingent liability. Now let's discuss the contingent asset as well. So this is again the only difference in this is the word which is used over here, possible. So it can arise due to some events, and due to some events it might not happen. So a contingent asset is defined as a possible asset that arises from past event whose existence will be confirmed only by occurrence and non-occurrence of one or more uncertain future events. So both have very similar definitions, contingent asset as well and liability as well, right? Let's take a more practical example, a much different than the study text one. Let's see. Okay, so what happens is that this is the person. He went to this restaurant, let's say with his family, right? And this restaurant gave him, let's say, old food, and he got food poisoning. So he got food poisoning. And what happens is that he might be admitted into the hospital for, let's say, 1 or 2 weeks. So obviously now he has to claim the damages. He has to reach out to the restaurant. He has to tell all the situation to them, right? Now, what's happening over here is that this customer is filing the case against them, right? So what's happening is that this customer is basically waiting. Basically, this restaurant, if we see the restaurant staff in this, they will be very scared, right? That we did the wrong thing. And they actually know that they did the wrong thing. So for this restaurant, this will be a contingent liability. But for this customer, because he is going to receive some benefits, he's not going to pay anything because he know that the restaurant is wrong. So the restaurant can prove him wrong. Yes, he can prove the restaurant wrong. So what's happening is that for this customer, yes, we can say that for this customer, this is a contingent asset, right? So this customer, yes, he will surely receive anything, some kind of compensation, some kind of damage, maybe a free meal for 2 or 3 months afterwards, right? What we say, a clean food, let's say. So this customer has, this will be connected with some conditions. So that's why it's a contingent asset for the customer. But for the restaurant, it's a contingent liability. Again, there, the two things are common over here, that this will depend on some kind of conditions. And the conditions may be, let's say, what the court actually does the decision. In many countries, unfortunately, what happens is that I've seen this from my eyes as well, that what happens is that people give lawyers much money, and the party which is giving more money to the lawyers, they are more, liable to them, and they help them win the case even though they are wrong. So let's say if
but
this
how this can be an asset? I don't understand.
because this customer will receive in the future some kind of compensation, right? He might receive some money, he might receive some vouchers, some gift cards. So he's only receiving, he will not pay anything. One thing is for sure, because he received bad treatment, that's why he will receive compensation. So that's why
So
it
it's
is
an asset for the customer, not for the restaurant.
yes, exactly. For the
Actually, it's
restaurant,
a liability. Okay.
exactly, for the restaurants it's a liability.
Okay.
Okay, but the unfortunate thing is that in some cases what's happening is that the restaurant might have some lawyers that are attached to the customers, and the lawyers may know the restaurant owner personally or anything. They might have a good relation with the restaurant, And what the restaurant does is that they may pay the lawyers more. So even though the restaurant is wrong over here, but these lawyers can prove them correct as well. So this is a separate topic, but this actually happens in the world as well.
Yeah,
Okay.
no, yeah.
So this is contingent asset and contingent liability. Let's see the example of this as well. So example is when business claims compensation from another party and outcome of that claim is uncertain. So obviously we can call this person as a business as well. So he received bad treatment. That's why he is liable to receive their compensation or any kind of medical treatment allowance in future. So that's why it is his contingent asset. Now, how much money he'll receive, at what time he'll receive, this will depend on many future factors, future events. That's why there is a word
Okay.
used, contingent.
Mm-mm-mm.
All right. Okay. Now, this was the table that I was talking about. This is very important. Let's discuss this because this will be tested in most of the questions that we'll practice for this. Now, this is accounting for contingent liabilities and contingent assets. So one thing was the accounting for provision that was separate, right? That we debit expense, credit provision, that was separate.
Yes.
But this thing is separate. So what this is telling is that there are 4 stages and these are known as probability of occurrence. Like how, what is the chance of them occurring actually, right? And there are 2 things written over here, liabilities and assets. First, let's discuss the liabilities, the contingent liability. So there are 4 things. I'll start from here, from the bottom. The word over here is remote. So remote means anything which is very far from happening, very far from reality, right? So if the case is remote, then both cases we should ignore. We should ignore the liability and we should ignore the asset. Because let's again take the example of customer. If actually he's just making a joke that he has food poisoned, the restaurant has food poisoned him, but in actual thing, the restaurant has not food poisoned him. They have given him clean food and he's just making a story out of it, right? So neither is this a contingent asset for the customer and neither it is a contingent liability for the restaurant, because neither the customer is wrong and neither the restaurant is wrong, right?
Yeah.
So in this case, in this kind of case, we'll ignore the liabilities and the asset, both things. So the percentage of these things are written over here as well. So remote basically means any chance which is less than 5%. So which is very far from actually happening. Now next thing is possible. So possible, as you can see, the percentage is given over here. Anything's chance which is between 5 and 50%, right? So it's not the majority, it's a point which is below the majority and it is called possible. Now this treatment is very important for this. For contingent assets, again, we'll ignore this. If the word possible is used in the question, like let's say lawyers have predicted that it is possible for them to pay. So obviously it cannot be a contingent asset, but for the liabilities, we'll just put a disclosure note because these 2 things, this possible and this remote, these 2 are the least ones. The higher ones are these 2 that we are going to study in just a while, probable and virtually certain. So for the possible, if it's a liability, it's more dangerous. For asset, yes, we can let it go, but for liability, it's more dangerous, even if it's for a company, a well-reputed company. So that's why it should tell to its shareholders using the disclosure note. So this is the treatment for possible if this happens. Now the next is probable. You can see over here probable. This is the case where yes, we can say the majority, like more than 50%, but not 100%. So the percentage range is 51% to 95%. So yes, this is much higher than possible. It has a much higher chance than possible. For contingent liabilities, we will provide for it. So provide basically means that we will record the liability straight away. Okay. And for contingent assets, we'll just recognize them. Right. By this record, I also mean, in other words, you can say provision as well. So this word provide came from the word provision. So we'll make a provision in probable because obviously we are just looking at the chances percentage. We don't know the actual time and the amount. Okay.
Sorry. So also here, we are talking about, for example, the business and the customer.
Yes.
Or just, about the business, like the contingent liability and the contingent assets. I mean, because, you've made that example that there is a customer with the food poisoning, and then there is the business.
Right. So I get your question. So basically you're asking that both sides should be business or both sides should be customer or business. So this is not important. Both sides can be business as well. So let's make one
Yeah,
more
but
example.
I mean, contingent liabilities and contingent assets can be, together in the business or in the customer. I mean,
Yes, they can be together. Yes, exactly. So
okay.
depending on the scenario, they can be together as well. Okay, but it's not just limited to this customer and this business. So two businesses can sue each other as well. Like one business has given to the other business wrong products or some products which it uses in its raw material, and that raw material is causing, let's say, a skin damage to customers, right? So this can be among business as well. This can be among customers as well, because obviously it's a legal thing over here.
Yeah, but this is always like, I mean, for one is always contingent liabilities, and for the other is always contingent assets, right?
Yes. Correct.
One
Yes.
that's paying and the one that is receiving.
Correct.
It can
Correct.
be
Correct.
in the same. Okay, that's fine.
Exactly. They can't be both contingent liabilities or they can't be both contingent asset. So one can be liability, one can be an asset. Okay.
Okay.
Okay. So if it is probable for the contingent asset, still we don't have a full, know-how that we will receive any cash or compensation or not. So still we'll disclose it over here if it is probable. So the highest version over here, the highest probability of occurrence is this virtually certain, of which the percentage you can see, it is, let's say, close to 100%, almost 100% we can say. Over here it's written more than 95%. So in this case, if it is a contingent asset, we'll recognize an asset. If it is a contingent liability, we'll provide it. That means we'll still make a full provision for it. Okay. So what happens is that, again, you might be thinking, what these words, where do we get them from? So mostly lawyers give us these words. Lawyers give the companies these words, that it is probable that you will have to pay. There is a remote chance that you will have to pay. It's virtually certain that you will have to receive or pay. So these will be written in every question that we will practice.
Okay.
Okay. So this was a table. You can also review it from the study text as well. This will help you in revision as well. Okay. Okay, now we'll straight away jump to the questions of the exam kit. Oh, yes, one thing is left over here, only one page. Let's do this quickly as well. So again, it's talking about provisions over here. So as I told you, that provision was the liability with uncertain timing and amount, and provision is directly connected with allowance for receivables, like we studied in the last class. So it is very similar to that. Again, that was very uncertain as well. This is very uncertain as well. So they both have very similar increase and decrease accounting. So in increase in provision, what we do is we debit the expense. In the allowance, you also remember, increase was treated as expense, right? Over here, it's also treated as expense, because it's like we're increasing a risk, we're increasing the liability. So anything which increases the risk, the obligation, the liability, it results as an expense, as a loss for the company. And credit, we do provision because itself it's a liability. So credit, provision, debit, expense. This is for the increase. And for the decrease, we do the opposite. We decrease the expense. The decrease in provision decreases the expense, and obviously it decreases the liability as well. We decrease the liability provision at debit side. This is the movement between the provisions. Okay. Now, last thing that is left over here is IS 37 disclosure requirements. Again, this is a theoretical thing. So what happens is that what things we need to keep in mind as a company when we are disclosing to the shareholders. So first thing is, when requirement is to provide for contingent liability, the liability is reflected in financial statements, but called a provision in order to highlight the uncertainty around it. Obviously, we have to, by provide, the word provide that we read in this table, this one, this means that actually we are recognizing a liability, but we are calling it a provision, because obviously there is a fact that cannot be denied, that we don't know the timing as well and the amount as well. Both things are not known. We need to tell the complete details to the shareholder in the disclosure. Then secondly, the movement in this provision, recorded in the financial statements. Obviously, if there is an increase or a decrease during the year, we need to tell the shareholders so that they should be ready to accept that profits for this year will be high or low. They can predict it easily using such predictions. Then last thing is, when disclosure is made by node, the node should say nature of contingency, like what are the actual events that will depend on the future. Then the uncertain factors that may affect the future outcome. Obviously, there may be uncertain factors that we have done something wrong, we might be wrong. So lawyers may detect that, even though we are paying very much amount to the lawyers. Then thirdly, an estimate of financial effect or statement if such estimate cannot be made. So the worst case scenario, what we need to do is that we need to tell the financial effect, that how much decrease it will bring to our profits during the next year if any bad result is given by the court that is not in favor of the company. So these all things, all kind of factors, it's very simple common sense. These are required for the um, disclosure to the shareholders. Okay, and this chapter has ended over here. Now let's take again a short break, right? And after that we'll start the exam kit questions. Exam kit questions are very less, they are like total 8 or 9, so I'll just do 3 to 4 questions with you just for the idea, and the remaining one you can try. So let's take 2-3 minutes more break, and after that we'll start. Okay.
Okay.
All right, let's start the questions. So the questions for this, I think there are just 9 questions. So I think they're, let's see where these are till. So yes, these are till 191. So there are just 9 questions. So I'll do questions till 184 or 185, and the remaining ones you can try and let me know if there is any issue. All right. So first question is 182. So all the things that we have studied are now being applied over here. So for which of the following items is a provision required in accordance with IS 37, which is this one. So this is testing about that table that we studied regarding the 4 stages of occurrence and all that. Okay. Now, firstly, a retail outlet has a policy of providing refunds over and above the statutory requirement to do so. So legally, it is required to give very less refunds. Same example that I gave to you about the supermarket, the constructive obligation and all that. This policy is well publicized and customers have made use of this facility in the past. So you can see legally it's not obliged to do. But the thing is that constructive obligation has come in between. That legally it is not obliged to make such kind of refunds, but this policy is well publicized and customers know about that. So second thing that we studied is that it's creating a valid expectation in everyone's mind, right? Even if they're not legally doing right, they have to just maintain the business relationship with the customers. So that's why in this case there is a constructive obligation. So therefore provision in this case will be required, because even though legally we are not obliged, but constructively, yes, we are obliged to the customers. So provision will be required. Now, secondly, a customer has made a legal claim against an entity claiming that faulty goods sold to them caused damage to their properties. Okay. The entity's lawyers, so our lawyers, have advised that claim will possibly succeed. So you can see there will be a word that we studied in the table. There will be a word used in every question.
Yeah.
If it does, compensation of 10,000 will be payable. So again, the word is possible. In possible, what we did was we just disclosed it to the shareholders. In case of liability, because we are making a provision, we just disclosed it. We did not make any provision. But yes, in the probable and the virtually certain, the above two, we had to make a proper provision. But in the remote and the possible, we did not have to make it. Just a disclosure is required. So that means provision is not required over here. Okay, right? All right. Now 183, let's see this one. Which of the following statements about requirements relating to IS 13 are correct? Okay. Number 1, a contingent asset should be disclosed by note if an inflow of economic benefits is probable. Yes, this is correct, because this is exactly what we studied in the table. Even if you look at the table, let me open it over here. You can see exact treatment. So it was talking about probable, right? This condition. So in probable, you can see there is a disclosure for contingent asset. Yes, it's available over here. Now, second thing, no disclosure of contingent liability is required if possibility of transfer of economic benefits is remote. Yes, it's correct. Because there is no disclosure, we just have to ignore both. If there is remote chances, we have to ignore the asset and ignore the liability. Okay. So this is correct. Now, third one, contingent assets must not be recognized in financial statements unless an inflow of economic benefits is virtually certain to arise. Yes, this is also correct, because it's trying to say that in all these second, third, and fourth, it's basically talking about the assets, contingent assets. In second, third, and fourth, we don't have to actually recognize the asset. Only if it is virtually certain, this case, we have to recognize it. We don't have to recognize it in second, third, or fourth case. In second, there's a disclosure.
Why, there is not like the option to put all of three that are, true. If you go to the solutions.
Yeah.
Yes. Oh, yeah, 1, 2, 3, A. Yeah, that's true. Okay.
Yes, exactly. So 1, 2, 3, all of these are true. So there is the option A, 1, 2, 3. These all will be true. Okay. So again, this was also testing you about the table application.
The table. Yeah.
Okay. So we'll do the questions till 185. Now let's see 184. The following items need to be considered in finalizing financial statements for Q company. So number 1, Q company gives warranties on its products. Q company statistics show that about 5% of sales give rise to a warranty claim. So this actually happens in real world businesses as well, that they specify percentage. Like if we are selling goods for $6 million in, let's say, 6 months, right? About 5% customers will come back and claim the warranty. So for those 5%, that means 6%, 6 million into 5%, whatever the amount is, that amount will need to create a provision, right? So obviously this will require a provision, because in actual real life world, this happens there as well. Okay. Now, second one, Q company has guaranteed that overdraft of another entity, the likelihood of the liability arising under guarantee assessed is possible. See, again, the word used is possible. So in possible, what we did was, for the contingent liability, we just disclose it by the note. No provision is required over here, right? So I think the correct answer over here would be option A. For first, we need to create a provision. For the second statement, we just need to disclose it by note, because the word over here is possible. All right. Again, this was the application for the table. So you can see the table is very important for even the exam questions as well. Okay. 1 second. All right. Now 185. Which of the following statements relating to the requirements of IS 37 are correct? So again, we have to see which one is the true. First, let's see A. A contingent asset must always be recognized and accounted for in the financial statements. No, this is completely wrong, because even if it is virtually certain, only then we'll record a contingent asset. In case of probable, possible, remote, we have to just ignore it. In possible, in the probable, we just have to disclose it, but in remote and possible, we have to ignore it. Right? Again, the table application is here. So must always is wrong over here. Okay. Now, B option, a contingent asset must always be disclosed in the notes to the financial statements. No, only if it is probable we need to disclose it. Again, the word must always makes this statement incorrect. Okay. Now, let's see option C. A contingent liability must always be disclosed in the notes to financial statements if it is regarded as possible. Yes, this is correct, because the only thing you can see, if it is possible for the contingent liability, we have to disclose it by the note, right? So that means this statement over here, option C, will be correct. Let's see D as well. A contingent liability must always be disclosed if it is regarded as probable. No, for probable, we have to provide it, not disclose it.
Yeah.
Right? So these questions are very simple to understand. Again, this topic was very easy to understand, right? And the remaining questions, we have completed the questions and the chapter as well. So any questions or issues that you have in the other exam kit questions, you can discuss it with me. And regarding the next class,